There is no end in sight. Interest rates are going to continue to rise. The Federal Reserve is really playing what amounts to a game of chicken with the bond market, because if you look at the balance sheet numbers, they came out again yesterday. Yes, the balance sheet was up, I forget, 20, 30 billion, something like that on the week, but nothing compared to the enormity of treasury bonds that are up for sale. And if the Fed doesn't step up the pace of its bond buying, then yields are going to continue. In fact, we got news yesterday out of the ECB that they are going to expand their QE program. Remember, Australia was the first central bank to do that. Now they're followed by the ECB. Why is the ECB doing this? To artificially limit the rate of increase in interest rates. Why? Because there's so much debt out there, thanks to the central banks artificially suppressing interest rates. We have a lot of debt, and now that the market is trying to increase the cost of servicing that debt, the central banks are at it again by trying to interfere with market forces in order to prolong the bubble. So I think the Federal Reserve ultimately is going to have to blink in this game of chicken. Otherwise, the yields are going to continue to go up. The 10-year, I think, could hit 2%, I don't know, within a few weeks. I mean, 1.635 now. And if the Fed does nothing, it's going to be a quick trip from 2 to 2.5, and then 3, and then 4. So at some point, the Fed is going to have to step up. I mean, they don't have to. I mean, they shouldn't. They should just let the whole house of cards collapse. But that's not how they operate. I mean, they may let it start to collapse. The Fed may wait until rising interest rates are an obvious problem for the overall market. See, right now, it's not a problem. I mean, it's a problem for certain stocks, certain tech stocks. The problem with growth stocks that have no earnings today is you're buying earnings in the future. And the higher interest rates are, the less you're willing to pay for future earnings today. What you want when interest rates are rising and there's inflation, which is the reason they're rising, is you want companies that are earning money right now so that they can pay you a dividend today that you don't have to wait for. And more importantly, if you have a company that is earning money right now because they're selling products, providing services that people need, people want, they can raise their prices. You have pricing power. If you don't even have any earnings, then it doesn't matter whether or not you have pricing power, because what difference does it make? You're not earning any money. You're not sharing your earnings with your shareholders. But if you are earning money, then you can raise prices and earn more money. And so those dividends can go up to help offset the inflation that you're experiencing. So it could take a much bigger move up in interest rates before the overall stock market is scared enough for the Fed to come running to the rescue. But in the meantime, rates are going to keep rising. Now, sometimes rising interest rates act as a competition for stocks. People might think, well, I can get 1.6% now on a 10-year treasury, so maybe that looks attractive. Maybe I'll sell some of my stocks to buy a treasury. Well, if inflation is 2% or 2.5% or 3%, or it's actually much higher than that, but what's so attractive about 1.6? I mean, that's what I said to this other theory, nonsense theory that David Tepper had, was that the Japanese are going to load up the truck with U.S. treasuries because they can finally get a positive 0.5% a year over the next 10 years. Who the hell wants that? Nobody is going to trade a stock that has a dividend yield of 4, 5, 6, 7, 8%. I mean, those stocks are out there. We're buying them. Nobody is going to trade those stocks to clip a coupon at 1.6, because once you buy that bond, you're locked into that rate. The bond's not going to go up as inflation goes up, but you own a stock, those yields are going higher. So at this point, bonds are so overpriced that it doesn't matter if they keep going up. If the 10-year goes to 2%, who cares? 2.5%, 3%? No one's going to take it because they can see the inflation. And again, it's not the nominal rate that matters to the investor, it's the real rate. And if you're not blind and you're not just simply distracted by the sleight of hand that the government pulls with the official numbers, and you actually open your eyes and look at what's happening in the real economy to the cost of everything that you want to buy, you know that a 3% yield isn't even going to come close to covering the annual rate of inflation. So people are going to stick with equities for a lot longer before they really start to look at bonds as being tempting. In the meantime, you still have this belief out there that the Federal Reserve is in a position to do something if inflation gets out of hand, which it's not. I mean, the markets believe that the Fed is going to have to deal with this impending inflation threat by raising interest rates. That's why the dollar is rising. That's why gold was under pressure. In fact, what really pressured gold this morning, and in fact was a catalyst for the big sell-off in the bond market, was the release of the producer price numbers for February. And the expectation was for prices to rise by 0.4%, which was a big slowdown from the 1.9% surge in the month of January. Meanwhile, the government is cooking the books to hide the inflation that there is so that they can pretend it's lower than 2%. And then you have the Fed saying, oh, inflation's too low, we need more, right? They're all working together to justify all of this money printing. But the investors at this point, they're not fooled by that illusion, and they don't want to buy these bonds. And particularly foreigners don't want to buy these bonds because they're the ones that are going to see the losses first when the dollar rolls over and collapses, which is going to happen. I mean, we got a rally today in the dollar, but it wasn't that big a rally. And then the rally lost steam late in the day. Look at the gold sell-off. Gold was down about $20 almost immediately after these numbers came out. Now, it was down before the numbers too, but it tried to rally back. And then when the number came down, it got smacked down again. Silver was down, I think, as much as 60, 70 cents. Gold has recovered, and it's now up about $4 on the day. It got down to as low as about 1,700, and now it's back at about 1,727. And silver couldn't quite make it back into positive territory, but it's only down about 15 cents, almost all the way back up to 26. So it seems to me that we've really washed out a lot of the selling here. A lot of the people who just assume the Fed's going to successfully battle inflation, maybe they're flushed out. At some point, it's the people who understand that they're not going to successfully battle inflation. They're not even going to battle, let alone secede. The government is going to concede the battle, right? They're not going to fight. They're not going to get in a ring with inflation. They can't win. And so inflation is going to knock out the Fed. It's going to knock out the dollar. And so gold's got to go through the roof. The dollar's got to go through the floor. And people are going to figure this out.